up. And of course, there's the bearish flag, which is pretty much the exact mirror image. You get a sharp move down, forming the flagpole, followed by a little upward consolidation, which forms the flag. This pattern suggests that even with that little bounce, the overall selling pressure is still very strong, and the downtrend is probably going to continue.
Okay, back to our reversal patterns. Here's one of the most famous ones, the head and shoulders. It forms with 3 peaks. A first peak, that's the left shoulder, a higher second peak, that's the head, and then a third peak that's roughly level with the first one, the right shoulder. When this pattern completes, it's often a super powerful signal of a bearish trend reversal.
And I bet you can guess what's next. There's an inverted version. The inverse head and shoulders looks just like it sounds, an upside-down version of the pattern. It's formed at the bottom of a downtrend, and it's a bullish reversal signal, hinting that that long decline might finally be over.
All right, so now we can spot these patterns. That's great, but recognizing them is only the first piece of the puzzle. How do you actually use this information? Well, that's where our 3-step action plan comes in.
The key here is to be systematic. First, you identify the pattern. Second, and this is so important, you confirm it. A pattern alone isn't enough. It's way more reliable if you confirm it with trading volume. See, a breakout from a pattern on high volume shows strong conviction. A breakout on low volume? Not so convincing. And third, you determine your plan. Know exactly where you'll get in, where you'll take profits, and most importantly, where you'll cut your losses if you're wrong.
Now, before you run off to the charts, we've got to cover the most important part of this whole explainer. This right here is the golden rule that separates disciplined traders from gamblers.
Let that sink in for a second. Always remember that chart patterns are not absolute. They are tools of probability, not certainty. They can and they do fail. The market can show you a perfect-looking pattern and then do the complete opposite. They are a guide, not a guarantee. Never forget that.
This is exactly why you never rely on just a single indicator. To really increase your odds, you need to look for something called confluence. That's just a fancy word for when multiple signals are all aligned. You combine your chart pattern with other tools, like candlestick patterns or the overall price action. When multiple signs are all pointing in the same direction, that's when your trade has a much higher probability of working out. So, we've learned that charts tell a story, we've met the main characters, and we have a plan for how to act. These patterns give us clues about the market's next chapter. So the final question is, now that you can read the story, what will you do next?